Okay, so today we're going to talk about what is a capital gain and what are the capital gain taxes or tax rates that are out there for individuals. And so to break this down simply, a capital gain is when you buy an investment. Let's say you just take like cash from the bank. This isn't going to be gains realized inside of an IRA or a Roth IRA, 401k. We're talking about money that's kind of already had taxes paid on it. So you've got money sitting in a bank account and you take $10 of that and you go buy a stock with that amount of money, or you go buy a piece of real estate, or if you go buy gold or any kind of investment. Okay, the gains on that investment is going to be taxed at some point in time in the future. So a capital gain is the gain that's realized over and above your original investment. Again, if I buy a stock for $10, it goes up to $15. The $5 in appreciation is my gain. If I bought a rental property and I paid $250,000 for my rental property and it had grown in value to $500,000, right? That additional $250,000 is the gain that I have to pay tax on at some point in the future. So that is the how the growth is really taxed. Now they have unrealized gain and realized gain. So I'm going to break that down very quickly. Unrealized gain is the amount of profit from my original purchase price to the value today. So again, if I bought the stock for $10, it's now worth $15. But if I still own that stock, that's an unrealized gain. It means that I haven't sold it. Once you sell that stock, that gain becomes realized, and that's when the taxable event will happen for you. Now, if you have owned that stock for less than 12 months, it will be considered a short-term capital gain. So how is a short-term capital gain taxed? People ask all the time, well, how much am I going to pay on my short-term capital gains? It all depends on how much other taxable and reportable income you have. So essentially, whatever tax bracket you're in, if you're in the 22% tax bracket, if you're in the 32% tax bracket, 24, whatever, 12, whatever tax bracket you're in, that is going to be the amount of capital gains tax that you owe. That's a short-term capital gain. So a lot of people try to avoid short-term capital gains because they are going to be taxed at a higher rate. Then you have what's called a long-term capital gains, and a long-term capital gains is just any investment that's held over 12 months in time. So as an example, if I have this stock I bought for $10, it's worth $15 and I sell that stock, the $5 gain is going to be taxed in that tax year. Now, there are 3 different levels of taxes as a long-term capital gain. One of those is 0%. There are a lot of folks out there that don't realize there is a 0% capital gains tax bracket. And for a lot of folks that are retired, we've been able to identify ways and opportunities for them to maximize and take advantage of this 0% capital gains tax bracket. If you've never seen what that looks like or know if that's an opportunity for you, or you think that's something interesting to consider, feel free to click on the link or give us a call in the office. We'll be happy to kind of unpack how that works and what individuals qualify for that and which ones don't. You may not qualify for the 0% capital gains tax bracket, but if you do, it sure would be nice to know about that, because capital gains taxes are on the table to be changed, and how they tax those and when. All of that's currently being discussed and debated, and so you really want to take advantage of opportunities that are there today that may not be there even next year or the year after. So that's a 0% capital gains bracket. Now, the majority of Americans will fall in the 15% capital gains tax bracket. 15% is, again, on that $5 of profit. I'm going to pay 15% tax on the $5, and that's what I owe to the federal government come tax time, that I'm going to have to be responsible for making sure that I have the money to pay the tax on that capital gain. So that's also on a piece of real estate. If you have a rental property, it's a little more complex with rental properties because you have your original purchase price, but then you get to allow for depreciation each year, which moves your cost basis up on an annual basis. And then it's the difference between that, any property improvements, minus the purchase price, but you actually have to recapture the depreciation on the back end. So real estate, rental property is a little more complex, but again, once we figure out exactly what that capital gain liability is going to be, and we're in that 15% tax bracket, we can plan accordingly for how much we're going to pay for that transaction. What we're finding a lot today is those here in Middle Tennessee, specifically, and really around the United States, that primary residences, as they're being sold today, that individuals are actually having to pay capital gains tax on their primary residence. I meet with people all the time, and they didn't realize that there could be a capital gain on the primary residence because it was their home, and have never had to even consider paying taxes on a primary residence when it's sold. So I moved from this home and I'm going to sell that and move into another home. Right now, the laws are that each individual can exclude $250,000 of profit over their purchase price and improvements, and exclude that from capital gains. Well, here in this area, if you bought a house that was worth $500,000 10 years ago, and today it's worth $1.5 million, then as a husband and wife, you can exclude $500,000, $250,000 per person. So I paid $500, I get to exclude $250 each, or another $500,000. But in this situation, I'm responsible for taxes on another $500,000 at whatever that capital gains rate is, again, 15% most likely. Then you also have to consider, if you are in some of these higher income earning brackets, the capital gains rate is up to 20% plus some additional surcharges that go along with that. So it's very important, if you're going to sell a piece of real estate, if you're going to sell a highly appreciated asset like a stock, that you consider what this tax is going to look like for you, so you know, is it the right time to sell that asset, or are there other alternatives, or should I wait until my income goes down? What am I really needing these funds for? So understanding what the capital gains tax rates are and which one you fall into is going to be really important, again, moving forward, as there are a lot of changes in this specific sector. If you have any questions about capital gains rates, feel free to check our website out, or again, call us in the office. One of our advisors are happy to talk to you and explain which one may be the best fit for you.